we had a really interesting episode with Warren Mosler, the godfather of modern monetary theory, earlier this week, in which he talked about how high deficit spending can actually be problematic. And he specifically described the current level of U.S. spending as spending like a drunken sailor, which is something you might expect.
A lot of people feel that way.
You would expect to hear it from like the Jamie Dimons of the world, and they've used that exact phrase. You would expect to hear it a little less, I think, from Warren Mosler.
I don't know. My entire lifetime, we've been talking about the deficit.
Yeah.
Nothing's changed, has it? There's no political will to do anything about this.
No, there's not. And the thing that really he identifies as the problem is not the deficit per se, and not even the debt per se, but the intersection of high deficits and debt with a Federal Reserve that's taken a fairly conventional approach to fighting inflation. And so in the MMT playbook, really you try to balance everything out with the fiscal. If you have too high inflation, you cut a little bit back. If unemployment is low, then you spend more, et cetera. Where he sees that sort of toxic mess brewing is that you have these large deficits. 7% deficits at a time of no recession is extraordinarily high by historical standards. You have a large debt stock, because debt to GDP is now over 100%. And then when the Fed is raising rates, the concern he has is that you raise the interest payments, and that becomes the self-perpetuating inflationary
But a lot
force.
of people really listen to this zeitgeist, which is not the Wall Street zeitgeist. And Paul, you're going to love this. Warren Mosler goes back to Beige.
I just saw that.
Did you see that?
Yeah, I saw that.
To Beige.
Wow.
And to William Blair.
Yep.
I mean, Tracy has no idea what we're talking about. This was the vogue 30, 40 years ago. Is Warren Mosler saying his thinking here, his theories, are the new vogue?
I mean, I think there has been a tendency in recent months for people to start talking about this idea that, oh, maybe higher interest rates are fanning inflation in one way or another, primarily through there's two ways. So one, if you have inflation that's coming because of supply constraints, then raising the cost of capital means that you're not going to be adding additional capacity to things like housing, things like transportation and logistics. So that's one thing. But the other one that is getting more attention is this idea that Joe was talking about, that people are earning more interest on their investments. And so maybe those people have a propensity to spend, and maybe that ends up as additional demand within the economy. The question is how much, right? And the question is also like, okay, I'm a millionaire in theory with lots of US treasuries, housing, stocks. Like, okay, I might get more income from higher rates on my treasury portfolio, but the value of my house might stagnate in a high interest rate environment or even come down a little bit, and the value of my stocks might go down as well. That definitely hasn't happened in this particular cycle, but I think that compositional effect is worth questioning.